Why is global economic policy coordination so challenging? Imagine trying to get dozens of people to dance in perfect sync, each with their own rhythm and style. That's similar to what countries face when they try to coordinate global economic policies. Countries have different priorities, economic conditions, and tools for managing their economies. Some focus on controlling inflation, while others aim to boost employment or grow their economies. These goals often clash, making it hard to agree on a common plan. Inflation is a worldwide issue influenced by many factors like rising commodity prices, disruptions in supply chains, and geopolitical events. When one country tightens its monetary policy by raising interest rates, it can increase borrowing costs and slow down spending. But if a big economy like the United States does this, it can cause borrowing costs to rise in other countries too, especially in emerging markets. This creates spillover effects that are tough to manage without international cooperation. Central banks usually focus on their own country's needs, like keeping prices stable and maintaining jobs. They don't always consider how their policies affect other nations. This can lead to situations where one country's efforts to control inflation cause problems elsewhere, like pushing other economies into recession or debt crises. The causes of inflation today are also more complex. It's not just about demand for goods and services. Supply chains are fragile, energy prices fluctuate wildly, and climate issues disrupt production. Raising interest rates might curb demand but does little to fix supply problems. Without coordinated efforts that include fiscal policies and investments to improve supply resilience, monetary policy alone might not be enough. Adding to the challenge are geopolitical tensions and trade conflicts. Countries are increasingly putting up trade barriers, which makes it harder to work together. When countries don't trust each other or have conflicting interests, it's difficult to agree on shared policies that benefit everyone. Finally, countries have different levels of economic strength and resources. Wealthier nations can often respond more easily to inflation with fiscal measures, but developing countries may have limited options. They might face tighter financial constraints, making it harder to participate fully in coordinated efforts. To make global policy coordination work, countries need to align not just on interest rates but also on fiscal strategies that address supply issues, climate risks, and social impacts. Building trust in international institutions and improving communication are also key. Without these efforts, managing inflation across the world remains a complex puzzle with many moving pieces.